Hello and welcome to the Baby Giants Investing Podcast. Join us as we chat about the weird and wild world of small cap investing, all while searching for the precious few fast-growing businesses that have a shot at becoming industry giants.
This podcast is for entertainment purposes only and should not be relied upon as the basis for investment decisions. Podcast guests and their clients may maintain positions in the securities discussed in this podcast.
And let's go. We're live here with Claude and Andrew. Gents, how you doing?
Good, man. Yourself?
Pretty good. All right, we've got a few things. We got to listen to a question today. We've got a couple of bits of good news to chat about. Thought I'd start off with some other general good news. Well, here's actually, maybe it's more like a quiz. There's something I read this week. I was going to send it to you guys, and then I thought I'd just ask you cold on the podcast.
Okay.
Who do you think is the scientist that has saved the most lives? Or what scientists do you think have saved the most lives?
Oh, I know this one. I'm going to go blank on the name, but it's the dude that came up with the way to fix nitrogen for fertilizer.
Yes, that's probably the biggest. So Fritz Haber and Carl Bosch saved 1 to 2 billion lives. It's around half of the world's population, about bit over 3 billion people today fed by that. So you could say they've saved much more than that, really, because all those people are alive right now. Every year, I guess they keep saving them. Yep, that's definitely one of the biggest. There's one other one that was very big.
Is it the smallpox vaccine?
That is on the list.
People?
That's on the list. Yeah, very good. Where's the smallpox guy? I think smallpox was...
Smallpox guy. we do the deep research here on Baby Jones.
Okay, Edward Jenner, 150 to 200 million lives saved from the smallpox vaccine. So this was a virus that used to kill 20 to 30% of its victims before it was eliminated. 500 million people, 300 million of them in the 20th century alone, and is like a horrible disease. Yeah, terrible.
Can I add to that? I mean, what I think is particularly, there's a lot of stuff that's impressive about that. But what happens, of course, is that technology and breakthrough, well, in this case, it happened sort of what we would term the West, and it was driven out pretty effectively. But of course, there's a lot of, corners of the world where it can linger and regroup and come back. And it was an amazing feat of humanity, I think, for them, for those that had the power to do something to actually chase it to those places, which just so often get neglected tragically. And for the greater good, feel as though there's a big lesson to be learned there, that it really benefits us in these very lucky, fortunate, rich countries to help those less fortunate. One, because it's the right thing to do. Two, because it helps everyone, right? It helps us as well. So that I think that's it's a great example of, you can imagine there was a lot of pushback. It's like, oh, we need to go to these dark corners of Africa. We need to go to the deepest, darkest jungles in, Southeast Asia and prosecute these vaccination campaigns. You could imagine a lot of people going, well, I'm not spending money on that. How does that help me? And it's just like, what a triumph.
Great. It's completely amazing. And yeah, I think some parallels. I always often think, like, how good would it be if we just eliminated like the common cold or something? There's a moment during COVID where it's like, could we do that? No, probably not. But maybe through some other magical technological invention we could. All right, one other big one that we didn't get was another one who did about 1 billion lives. It's kind of related to your first one. His name was Norman Borlaug, and he invented high yield wheat. This type of dwarf wheat that allows very high yields of wheat to happen by making the wheat not grow too top heavy and falling over about 1 billion lives, and kind of solved hunger in India and Pakistan, averted famine in Pakistan and India. And yeah, it's kind of the green revolution largely tied to that one as well.
It's amazing. Things that are huge but just unknown is amazing.
Mm-hmm.
Do you know there's another, can I throw in another one, a late candidate that's just occurred to me? And again, you're going to have to fill in the details because I'm not a details guy, and everyone knows that. What was the story of the Russian Missile Command soldier?
Yeah. I know the guy that you're talking about.
Right. So he's the nuclear warning systems were going bing, bing, bing. The US has just launched a nuclear attack on the USSR at the time. And every single protocol, every ounce of training was like, well, retaliate. That's what you're trained to do. That's what the protocol says. Do it. And he didn't. So he defied orders. He defied training. And as it turned out, it was a false alarm.
Yeah.
But you can imagine that if he had done, in fact, what 99.9% of people would have done, and I'm sure many in the military would have argued should have done, is launched nukes, which would have actually prompted a very real response from the US. And we're all living like Mad Max Thunderdome right now had that occurred. That's a fascinating story that enough people don't know it.
100%. His name was Stanislav Petrov.
That's it.
And yeah, 1983, I've just pulled up the wiki for him. There were his like radar screen said that there were missiles coming in from the US. It was just after the Soviet military had shot down a Korean air flight 3 weeks before. Saw a missile, then it was followed by up to 5 more, and he basically disobeyed the orders against the Soviet military protocol, credited with preventing an accidental or erroneous retaliatory nuclear attack. Yeah, that's probably the biggest, I guess. I hadn't thought about that. I guess it's not a scientist, but yeah, that's wild. There's like a few other stories of that during the Cold War. There was a Russian submarine during the Cuban Missile Crisis where they were being forced under the water by the or they were diving down and they had lost communications with Moscow. And there was like 3 people in the submarine that needed to all agree to fire a nuclear torpedo at the Americans. And the Americans were depth charging them, trying to get them to surface. But they thought that it was like thought they were in a nuclear war, basically.
Wow.
And one guy refused to. And they were all suffering from carbon monoxide poisoning as well. So they were like losing their minds.
Yeah.
And literally 1 out of the 3 refused. So yeah, pretty cool.
That is, I think the lesson here is that these are all very low probability edge cases, but these fat tail events have massive consequences. So it's kind of like low likelihood, high impact kind of things. I, for one, am very supportive of efforts to mitigate and prevent those. So, for example, I kind of wouldn't mind if we spent billions of dollars on asteroid defense. And like these things are a little bit crazy, but you kind of think, of all the money and billions and if not trillions that we've wasted as a species, it's kind of like, well, if we never need it, great, right? Like that's pretty cool. But it's like the moment that you do need it, it's like you're very, 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 very glad that you've got it. It's kind of a bit tragic. I'm sure you're probably going to jump in on this, Claude, was, that we, given the experience we had in 2020, 21, 22, is that we're not building like vaccine manufacturing hubs all around the country and stockpiling toilet paper right now just for that next 1 in 100 year event. But anyway, it's a good example of just how close we sort of fly to the edge with a lot of things and are oblivious to it after the fact.
Yeah. It's that resilience versus efficiency thing, I guess, as well, right? Like, yeah.
There is a part of me, I'm going to sound like a crazy prepper here, but there's a part of me, and I haven't done this, but I often think, I should just have like a tub in the garage, which just has like some water purification tablets, some baked beans, pack of matches, candles, just a whole bunch of stuff that I'm never, ever, ever going to use. And on my deathbed, I can laugh at how I spent like $300 that time for my Doom kit that I never used. And like, who cares? I'll blow that on a dinner, right? Like easily. But it's sort of like, and like 1 in 1,000, 1 in 10,000, I don't know, make up the numbers. But there's a time where it's like, when the zombies come, I'll be like, I'm really glad I did that. Or is that crazy?
No, I agree. I think I'm just making me think I should do more of that. So like with COVID, Claude and I were pretty early. I think I'd been chatting to you about it. So basically, if you were following the right people on Twitter, you kind of became, it was like you were watching the world 3 weeks ahead, like during that time. And I remember starting to order stuff. Like I ordered all this stuff way before. And my wife was like, what are you doing? Like, why are you stocking up on these things? Like, bought like all this, sanitizer and face masks and stuff. Yeah, teenage sister's like mocking me and showing me these TikToks about how COVID's not a thing and there's nothing going to happen. And then it's just like, you just watch this like information cascade of it all happening.
Yeah.
So now I've said like, next time I go crazy like that and try and stock up, you have to listen to me. Like,
you've also got to play the counterfactual. Like, let's say it hadn't been, right? And let's say that they did laugh at you rightly. Well, I would argue actually, it's still...
Yeah, it's still not. It's not like
it's
I was
risk.
Like... Yeah.
There is a line here with what is ostensibly an investing podcast here, right? Because, it's like you can do the right thing and not get rewarded, and you can do the wrong thing and get rewarded. We talk about that often. And I think this is a really good case. Just because you didn't need it, was it wrong? When the potential upside is so vast and the cost of being quote unquote wrong is so, nothing. It's kind of like the most rational thing to do.
Yeah. No, 100%.
So I don't necessarily think that financial assets are the way to play, I guess, global instability. You often hear, people like, I think, Andrew, you just said off air, like, what do? You buy puts or whatever. But like other people buy gold. I know you love to buy Bitcoin, but I don't necessarily see those as...
I'm like, hold him back. I'm like, the guy that wants to run into the fight. I'm like, stay down. Okay.
I'm not saying that the only reason you'd buy Bitcoin is because you think the words will...
Can I just say very quickly interject here before you characterize me wrong? It's a very, very low down the list of reasons, but continue.
Yeah. I know that's not your reason or anything, and that's fine. And I think probably Bitcoin does well in environments other than that as well. But the point is that I've always thought it was like kind of bizarre. Like you would buy gold or any kind of financial asset, because if things really do get hectic and unpleasant, then what people are really going to value is they're going to value being away from other people, basically.
You want a portfolio of seeds and shotguns, essentially.
Yeah. So what you really want is, if you think that there's going to be like a collapse in social harmony or whatever, is you want to have, somewhere that is sturdy and secure and like resilient. It's like the resilience, right? You want resilience. So that's why, to me, I'm sometimes appealed to once again by a house that's like relatively remote, in relative wilderness, near a river, that kind of thing, that you could potentially build into something that is some sort of like sustainable retreat. And I also wonder, does that not work as a financial asset as well? Like, I definitely think that I benefited from the fact that Chloe and I previously bought a house that was in an area that was already becoming, and continued over the next 7 years to become more and more popular with, basically people retiring and wanting
tree changes.
Yeah, tree changes. So, and that's always the way, is you want to be like, okay, who am I going to sell this to? Because if you want an asset to appreciate, you want to sell it to somebody who has a lot of money. So if you bought a rural property now that's well out of the way, hectares, has some trees areas, has some cleared areas, you build a house in a cleared area so it's not too vulnerable to bushfires. You've got access to water somewhere on the property. You put in solar, you put in some sort of, septic system or even like composting system, and basically make an off-grid sustainable house. One, that could be useful if things really do go badly and you actually do want to bail and hide out somewhere. And two, even if you don't, like, even just if there's a point in time when people are freaking out and that kind of move becomes more popular, you've got a ready-made asset there that you could probably sell to someone that does have a lot of money as well. So
that's a good one.
I don't know. I still see like potential in that kind of investment. Like, I definitely don't see the appeal in, I don't know, buying and renting out an apartment, let alone like, it's never appealed to me, even if it can work out.
I can't say I expected the good news section to pivot into post-apocalypse investing
Come on,
strategies,
it
but I'm
always
absolutely
does.
for it. Okay. So your move in during this, basically to have a big bit of land, something that could survive something bad, and that's kind of like your prep. Would that be fair? Is that what you're thinking?
Yeah, I think what my next move is, I want to buy some land that has, because the last forest we bought was like really just all forest, and that kind of concerned me regarding bushfires. So this time I'd like to buy land that has some forest and some cleared area.
I'll give you my take on it. Is I hear what you're saying, and it's got big advantages of that approach because you can do a lot of work on the site. But also don't forget that property rights and national park boundaries are really going to mean very little in this hellscape
Okay,
world.
here's my pitch, which I have not done, and maybe it's my rationalization. What about a yacht? During if it's a fan, you just sail away. You can live on a yacht basically indefinitely. You can sail around the whole world. You can literally go anywhere else.
Yeah, I love it.
That's
You just make sure you get some water filtration devices.
You can make water on the boat.
For pure
catch fish,
survival, that might work, but I wouldn't want to be on a yacht constantly.
No, you sail to there's some island surely it hasn't ended everywhere. I like that one.
Fort Denison is my go-to in Sydney Harbour, right? So you've got the parapets. It's like we'll just
in swimming distance, man. Come on.
Yeah, I need to think that one through. Don't I?
All right. I don't know how I'm gonna. What else are we gonna chat about today? All right, let's go.
Well, can we do that? Can we very quickly do just to segue that nicely? Would you go? I know that none of you do, but I guess the question that some might be wondering is, like, given the tone of that conversation. I mean, I think continually hedging, I think most people agree, is a bad idea because generally markets go up and generally it's just going to like hamstring you. But if you were to buy sort of deep out of the money puts and just roll them over periodically, so that it's probably only going to shave off 0.5%, 1% of your average annual return, but really make sure that you're protected in the case of like a depression style scenario. Is that, I mean, it's hard to, you probably can't do it with each individual holding, particularly in small caps, but you could probably do it with an index based options put contract or something like that. Is it something you've ever looked at or considered, or what's the flaws in that?
I personally haven't. I've seen people do it, and so it depends how much you hedge, right? So if you're going super deep depression style, then yeah, it probably might be 0.5%. But if you're talking about, I want to protect from a normal crash of 20 to 30%, it's more like 2% or something that you're paying a year. So like it does start to add up. And I've seen other investors do it for a while and then go, actually, I'm not going to do it. And you just wonder, are they going to take off the hedge just as a crash comes because they do it when things feel clear? So it's not one for me. I think it's all just like your own. There's nothing wrong with that approach. It's like what fits your, what would you say, like risk tolerance and, allows you to keep investing basically. So
and be aware of the compromise.
Yeah,
right? Just there's no wrong answers, but just understand there's no free lunch, right? Like there's a cost to that.
Yeah, and so for me, it's like trying to own businesses that could survive a recession or a downturn or something like that, And generally, or if you own some that you don't think would survive something really severe, just being aware of that, so it's not a very big part of your portfolio.
Never a forced seller be.
Yes, that's a good one. I like that. All right. Well, maybe that's a pivot to a question that we had because Spoilers FC hit us up on Twitter. Hey guys, came across the pod about 6 weeks ago and it's a fantastic listen. I've learned a lot from listening back through 20 to 25 eps so far and look forward to the new eps dropping. My question for the pod is related to selling. I've been investing for about 3 years. Wild ride so far. Yep, that's pretty wild, 3 years. And always struggle with pulling the trigger to sell. Fear of selling a stock only to have it pop right after. Wonder if you guys are able to talk through the last couple of stocks you've sold and why you decided to offload the stocks. I'm sure there will be some great insights there. I'm just trying to get a bit of feel for triggers to sell from experts that have been doing it a lot longer than me. Thanks. What do you guys reckon? Claude, Andrew, any thoughts?
You go first, Claude.
I think it's always a risk it's always a possibility that you sell the stock and then it pops back up after that, especially for example if you're sort of selling in a panic. So I try not to sell in a panic, but other than not selling in a panic, sometimes panic, basically the rule with panicking is panic early. So if some bad news comes out and you really are in a position to act before the market reacts, then I don't think there's anything wrong with just like doing that and reassessing later. But otherwise I generally would say, look, it's better to not sell in a panic because usually if the market is panicking and there's a massive drop, then usually you get a little bit of a bounce like a day or two later when I guess there's less panic in the air. And I would say if actually the bad news that or whatever it is that's making you want to sell is genuinely bad, then you're better off just selling out on the pop really, or on the bounce. And then other than that, it's just a form of anchoring, right? Like this thinking is sort of anticipating anchoring where you don't want to sell and you essentially think that if you sell then you'll miss out on gains you could have made. Whereas the way I would think about it is that if you sell and then something changes about the risk reward, then you're always in a position to buy back in. So generally speaking, and of course it has happened to me plenty of times where I've sold a company and the share price has gone up afterwards, both because I've just taken profits and it keeps going up and also because it's come down and I've sold and it then bounces back up. Generally speaking, I think, well, look, why focus on the sell as the mistake? It could have been a mistake. That may well have been a mistake. But also equally, maybe the mistake was that you just didn't buy back in. If things changed, then it could have been a mistake. You could think of it as a mistake of commission, but also a mistake of omission. So thinking about it like that can take off some of the pressure, I guess, in terms of selling. I don't think it's that useful to worry about something bouncing back up later, just because like that just basically is saying, well, that could happen all the time. So you're just going to never sell, essentially, if you're always worried about that. So I try not to worry about that too much and don't think that it's just the sell decision that's at fault. If something does bounce up, maybe it's like you didn't make a buy decision that you should have. And other than that, I guess I'd talk through a couple of sell processes. One example that I think, is very topical, for example, is quite some time ago, I sold my shares in Volpara because basically they weren't on a very good trajectory in terms of their cash flow. Since then, they have improved their cash flow situation. They've had 2 quarters that have been either positive or pretty much break even. And they've even said now that, that they basically think that they're going to have close to enough cash to get to break even. So that story has changed. The share price is now, after that good news, the share price is now like a little bit higher than where it was when I sold it, which was more than a year ago, I think. I can't remember exactly, but it was a while ago. And basically what happened is I sold it, the stock kept going down, things started to improve, the stock came back up. To me, in my mind, I would say, well, first of all, I haven't foregone massive returns on Volpara by selling it, but more to the point, I'd sort of say, well, I think think that the mistake was not buying it, I guess, when the fundamentals did start to improve. And maybe the mistake's not buying it now. So I'm not so focused on the sell being a mistake as just the last 6 months. It's, traded plenty of times below the price that I sold it at. And even now a bit above. Like, who cares? If I think it's a good opportunity now, I should buy it. And look, I do think it's interesting, which is why it came to mind. Then, for example, I think it can happen quite a lot, really. And that is quite a pain trade where you do have to hold a company, it goes down and then it gradually comes back up and goes higher. So another way to think about it is also, well, don't forget there's an opportunity cost as well. So the stock that you own may go back up, but also you could have potentially bought something else that could go up as well. And so I guess a final more classic example of a sell essentially is just when one's thesis is broken. So this is one of the advantages of writing down a thesis. You don't have to write like a whole article like I do. I think even probably for the everyday investor, the most important thing to write down is why you own it. And that then gives you something that you say, well, if that's breaking, if that's not working out, then I should consider the thesis broken. So I guess maybe a better example of when I sold something because the thesis was broken is with E-Road a while back. Both the CEO quit and the CFO in a fairly short amount of time. Both of those things are sort of things that I consider a bit of a red flag, but especially when they come with a couple of other bad things. So on top of that, there was a guidance miss, at least one guidance miss in there as well. So a couple of negative signs like that was enough to make me sell. If anything, in that case, I probably should have sold faster. And that's an example of where, the sell is probably fine because it worked out okay for me because I should have sold a lot faster than I did. But the initial decision to start selling was pretty good. I just should have sold it all quickly at that point because you had a number of sort of thesis breaking points. The growth trajectory wasn't there. The management that I had sort of bet on were leaving. And that procedure meant that if I'd sold then, it would have gone down a lot lower. Now it's gotten a takeover offer and somewhat doubled off its lows. But the point is it's still lower than when I sold. So I think basically if you have a process where there's a thesis and if the thesis is broken, my approach would be generally sell at that point and then reassess afterwards. And if you think, well, that thesis is broken, but there's another thesis that makes sense, then you can buy back in. And that can be risky because there's anchoring involved all throughout it. But if you can just really try and keep a clean slate, then I don't think it matters if you do sell something. And if that doesn't mean you can't come back to it, essentially.
Nice. That's a great overview. What do you reckon, Andrew?
Yeah, this one comes up a lot. It feels like we've talked about it before, but it's always worth reiterating. I just think the main lens to look through is opportunity cost. I mean, they're just opportunity cost, opportunity cost, opportunity cost. And whether you're Warren Buffett or you're Andrew Page, there's only so much money you've got. And it's always a question of where is the best bang for my buck, And I like to be reasonably concentrated. I'm a big believer in diversification. I don't think there's any real point having 30 positions. I think I adequately diversify with anywhere sort of between 10 and 15 stocks. I'm very comfortable to overweight into high conviction opportunities. And it's just, I think it was Hamish Douglas or someone who first sort of used the analogy of a sporting team, right? Like I've got all these players on the bench and I can field anyone at any particular time. And I'm going to put the best players out on the field. Now I'll be wrong a lot, inevitably, but I think the key is to make the best call that you can at the time, have the awareness to realize that a lot of them will be wrong, and when that is, that to make the necessary change. And I think that is just, I just keep coming back to that again. Just to answer the specific question in terms of recent examples, one recently was Dares earlier this year. I sold out of that at about $2 or so. I had this, I don't know how many times I have to make this mistake, apparently lots, where I fall for the classic value trap. It's like, oh wow, this has got a lot of problems, but man, it's so cheap. Felt that Adair's fell in three, which is probably true, but I also just felt as though things could get a lot worse before they get better. And basically it was a lack of conviction. I just got out. So I think you will do your head in after the fact going could have, would have, should have, oh, the price went up. Oh, that was a mistake. Well, not necessarily. I actually think if you sell for the right reasons, and this is back to you before buying the hand sanitizer in the early days of COVID, right? Like you can, things may pan out that you would say, oh, that was the wrong decision, but that's with the benefit of hindsight. If you have legitimately lost conviction and you sell and then the market doubles after that, was still the right thing to do, right? And so don't beat yourself up on that. And it's a game of probabilities, except that you're going to get it wrong a lot, like really a lot, like at least 40% of the time, if not more. And that's just par for the course, right? And so whenever that as Claude just touched on it, so I'm just repeating him here, but whenever the thesis is busted, I've written it down. This is why I like it. This is what I'm looking for. Okay, that is no longer true. You sell, and then you can reformulate if you need to, or you can contrast it against other opportunities that are out there. Super easy to say, I know, but that is 100% the process for me.
Yeah. Nice, man. Yeah, I wrote something about this a few years ago, so I might refer to that one on mattjoss.com called The Selling Blind Spot.
Oh, great article.
There, it's still there. Yeah, thanks, man. But yeah, I was just talking about some research that was kind of led with some research which said basically professional investors are basically skilled in their buying, but selling decisions tend to underperform on average. And it talks about some of the reasons why they speculate that is. And I think it's basically that when sales, like when people are buying, they tend to be more forward-looking. They're thinking about the prospects of the company. It's like a more careful process. But the sales tend to be more backwards looking, like has this performed for me well or not? Like it's more looking at past price movements, not the fundamentals.
Irrelevant.
Totally. Yeah, and it can be more rushed and ad hoc. It's more likely to be emotional, as Claude touched on. The reason like that he doesn't like selling into a panic is just to avoid those rushed changes. And so yeah, these are all things that I think typically mark out sales, and that's why it's a part of the industry or like the skill of investing that doesn't really get much attention, because all the focus is on buys. Like every broker is all about trying to get you to buy stock. No one's trying to get you to like learn how to sell stock well or sell shares well. And I think you guys have already covered it, both of you really. One, for me at least, is just selling when a thesis is broken, selling quickly when a thesis is broken, and trying to be like, have that as like a discipline and something that you want to do basically, so that if you change your view, you have the kind of like an identity thing, like you identify that I'm the type of person that likes to sell quickly if a thesis is broken. Kind of gives you the freedom, I think, to change your mind, because like we talked about with anchoring and confirmation bias, it's very easy to just get stuck and let what you'd call thesis creep, which is when your thesis for owning the stock just kind of creeps along with the new bad news that comes out.
I'm a sucker for thesis creep.
Yeah.
That's bad news, but now it's in the price.
Yeah, now it's in the price.
Now it's in the price. Yeah. I concede that is bad news, but now it's in the price.
Yeah, exactly. So yeah, in that one I talked through an example, which is probably the best one just because I sketched it all out. It's a few years old now, but it was Class software, super kind of self-managed super fund management software. And for that particular example, at the time that we owned it, the thesis kind of broke and caused us to sell. But I think the other point is that Claude mentioned is just that it's not like this one-time thing, right? Because you can literally rebuy tomorrow. It's only our bias towards not reversing our decisions that stops us from rebuying if we realize we made an error with a sell. So yeah, coming back to the original question, you don't want to regret selling something that then goes up. There's no reason that you can't buy it again. And it'd be much better, and I have done this before, where I've sold something. Actually, A2 Milk, when I first started, I sold a very large part of it when it first ran up to $2 or something, and then realized I made a mistake and bought it back like a week later. And that moment was the right decision. Obviously, it won't always be that way. But yeah, that basically you pay a penalty for whatever it moves in that time. But if this is something that you think is going to go up, multiple fold from there, it doesn't really matter. So yeah, I guess ignore the past. That's probably the first one. Make the decision on the fundamentals that you see, and be willing to just ignore all your past decisions and just look at it with like a clean slate. I agree with all that.
I'm trying to remember the quote, but it feels like a Munger quote, which is, "You're not right because the market tells you you're right. You're right because your facts and your reasoning are right." And it's just like it's such a hard lesson to learn, to have, like sketching. We talk about, we use this word thesis. What's the rationale here? Why do I like it? Why do I think the business is going to perform? And why do I think the market price is not reflective of that future performance? Essentially, and you can have really good reasoning, and the market can take forever to sort of realize on that. And it just has this thing screaming at your face that you're wrong, you are wrong, you are wrong. And it's like, well, am I actually, in the way I formulated it? No. And it's brutally hard to calmly walk in one direction when there's a screaming mob, screaming bloody murder running the other way going, oh my God, we're all going to die. Like, it's a very, very hard thing to do. But I think that is a core skill of any successful investor. You have to have that ability to recognize that, the market can be wrong for much longer than you can remain liquid, as the old saying goes. And you just need to remember that, don't use the market to tell you whether you're right or wrong. We can't have it both ways. Like with investors, we go, when we're buying something, we go, oh, the market is clearly wrong. It's cheap. I mean, why else am I buying it? And then the second that we own it, oh, the market's gone down 10%. Oh, it knows something that I don't. I need to get out. It's like, well, is it right or is it wrong? And it's like, it's just, I guess philosophically, I can sort of say, well, actually, the market's always right because that's just what the price is right now. But is it right or wrong through the context in which the way you formulated it? I think it's often wrong. And I think it can take a long time for things to sort of, prove themselves. I'll give a very quick shout out. I always suck up a punishment because it just gets such feedback. But anyway, I'm going to go with it. Catapult was 60 cents earlier this year, right? It's $1.05 now. Now, I'm not going to do any victory lap here because it has not been a great investment overall, but it swings wildly between these two things. And I think I feel as though I formulated it, I don't think things have radically changed too much in recent years, but the price has changed radically around that time. And I can guarantee, who knows what's going to happen with the price, but I can guarantee if this now gets to $1.50 or something from here, everyone will start screaming into it and running and buying it. Again, because the market has sort of indicated, sort of validated and anointed this as something worth buying because it is sort of seen as something that is now credible or whatever. And it's like, well, actually, what's actually changed with the business and the outlook in the last 12 to 18 months? I don't think actually anything, really. I shouldn't have gone with that example because there are dozens of others, but I don't know. I'm babbling at this point. Someone jump in and save me.
When you started talking about Catapult, because most of our listeners...
Hey, at least it wasn't Bitcoin.
Someone's tapping the fast forward 30-second thing on their podcast play. No, I'm just teasing. No, I think that's a very good overview, Andrew. Maybe we'll move on just for time to the next thing. You shared a chart, Claude, of working from home stats and employment. Do you want to just run through that to the extent we can?
Yeah. So I thought for a bit of discussion, there was a kind of engagement baity tweet that I shared with the guys during the weekend and actually retweeted it without comment, that basically said it had a chart that said that shows the growth in employment by number of days required in the office. So it divided companies up into companies that required 5 days in the office, 4 days in the office, 3 days in the office, 2 days in the office, 1 day in the office, and 0 days in the office. And then they measured what the company headcount employment increase as a percent was. And for those firms surveyed that had 0 days in the office required, it was 5.6%. 1 day was 4.8%, 2 days 4.7%, 3 days 4.4%, 4 days was 3.8% growth, and 5 days being 2.6% growth. So what it shows is that essentially out of 3,600 US firms, those requiring 0 days in the office are basically growing their number of employees at around double or even a bit more than double the rate of the companies that require 5 days in the office. The takeaway that this tweeter, this economics professor had was that work from home increases recruitment and retention, which fuels company growth. I don't think that isn't, I feel like that's a provocative thing to say. It's not in any that I can see in any way actually supported by the data. I guess equally provocative, but taking a different tack on it, was Mr. Microcap Jesus, who replied saying, I think the most obvious take from this graph is that companies with more flexible work from home policies have had to hire more staff. And I think, I guess the cheeky implication there is that, well, actually you have to hire more to get the same job done because they're not walking as much. I don't think that's supported by the graph either, nor is it an obvious takeaway to me. But what I do think the obvious takeaway is, and I think both of those observations are possible, by the way. I do think it's possible that work from home does to an extent increase recruitment and retention, although I'm not sure that fuels company growth. And I definitely think it's possible, it's a statement of fact that more flexible work from home policies have had to hire more staff. But I would just invert the whole thing. The obvious thing for me is that companies that, for whatever reason, need to hire more staff are having more flexible policies with regards to work from home. And I think that is, whilst neither necessarily saying work from home is good for productivity or work from home is bad for productivity, I don't think the graph tells us anything about that. I think what it tells us is that more flexible arrangements regarding remote work, which is really a better way to talk about it than work from home, but more flexible arrangements with remote work are something that firms will bring in if they are growing quickly, because it really matters for them that they are able to retain and hire. Yet companies that are retaining, like that are not having to hire so much and not having to grow their workforce as much, I guess are less concerned about retention and hiring. So they're more in a position to enforce what I would argue where it's unnecessary to be in the office 5 days a week. Now, I think it's kind of considered probably a little bit extreme, and it definitely probably would hurt your retention and hiring ability. So I just think that the real takeaway from this chart, which, everyone can get their own takeaway from it apparently, but I think that the real takeaway from it is that work from home is considered a positive for the actual employees, and it's considered a good thing, and it's something that is therefore likely to attract people to the company and also increase the number of people who stay with the company. And the reason I think this is the big takeaway is because this is also supported by first principles reasoning. Like, just the reality of it is that, there are lots of scenarios where, somebody's ability to pick their kid up from school at 3:00 on some days and 4:30 on other days is meaningful to some people. Somebody's ability to basically, I guess, take their dog for a walk at lunchtime or whatever it is, or be around the house for their elderly, parent, or whatever everyone has their own life, whatever the specific needs someone have. Remote work usually makes that possible. And that's a huge deal. And that it has actually been probably one of the biggest changes in how the world is organized arising from the pandemic. I think we were heading in this direction anyway, but it's just accelerated it massively because everybody got a taste of it. And everybody got, there's another survey I read that suggests workers are willing to accept on average around 7% less pay if they can work from have flexible working. And it just makes sense because not only do you save money in the commute, and that can vary greatly from person to person and how they commute, but most importantly, you save time and you save going through an unpleasant process. So it makes perfect sense that people would prefer minimize that. And I think that is a trend that's not going to be stopped.
Yeah, I don't disagree with any of that. I guess I take a more agnostic view of it in that markets will do what markets do. And that some workplaces will offer more flexible arrangements, others won't. They'll do whatever they can to attract employees that go outside of just the strict remuneration structure of things, and it'll find its place. Some people like Elon will say, no, you have to do it. Others will go, yeah, do what you like. We don't care. And it's one of those things that's hard for me to rage at because it's kind of like there is no right answer for everyone. And people will do business, employers and employees will all do things that they feel is right.
It's a voluntary agreement, basically.
Yeah, the market will reach some kind of equilibrium point, and it's kind of like, it is what it is.
One quick thing, on the productivity thing. So we work remotely and we've kind of been used to working remotely for years, even before we launched our own businesses. And I think for some businesses it really works. Like I think investing is one where you kind of need time to yourself to think of independent ideas, even when you work in a team. I do think that's, there's somewhere it's it's definitely harder, right? Like if you're collaborating on a physical product and R&D or something, that would be pretty hard to do remotely until
the plumber's not going to work from home every day of the week, right?
No, not for a while. But one other point I would just make though is when I was at a conference recently where Governor Lowe presented, and it was also a presentation from some of the people in the Fed. They were talking about how productivity was mysteriously falling over the last kind of 18 months to 2 years. And there could be different causes for that. They didn't pin it on working from home too much, I think. Yeah, it's just kind of interesting to think if there is some roles where it has actually been hurting productivity. And we were kind of chatting before the pod of, it's very easy to index when you really love what you do, like we do, and kind of forget how many people don't really love what they do in their work and would quite like to just zone out a little bit more. So I do wonder if there is more of a productivity effect in some areas. Where for some it's a productivity bonus, for others there probably is a productivity tax or a fall in productivity if people who don't like their jobs get a chance to not do them as much.
I'm a little bit cynical on that too. I tend to think if you hate your job, your incentives are everything, right? And if I really can't stand my job, but I have to continue to work because there's certain economic realities for my life, I will do my incentive is to do the bare minimum not to get fired. I mean, by the way,
yeah.
Office Space is the best movie ever made, right? So go and watch that. And that's what he quotes in that. It's just like, that is Bob, when he's talking to the two Bobs, that's what I do here. I do the bare minimum not to get fired.
And he's like management material.
If you've got exactly, if that's your problem as an employer, where you just really your employees just can't stand working there, whether they are in front of you or whether they at home, they are going to do whatever. Yeah, like the bare minimum is the reality of it.
Yeah, what I'm saying, I think working from home lowers the bare minimum because it's harder to police. It's harder to like track what people are doing sometimes. And you could say in some ways
depends on the
like
job, but yeah,
depends on the job. But I think overall, it's probably easier just out of sight, out of mind to like slip off the radar. But yeah,
I think that's an interesting point because I like the reasoning from first principles kind of way, because it's always hard to understand causation when you've just got data. So I do think that it's almost certain that, you know, for some people, like work from home does lower the bare minimum. You know, just simple facts, like it's harder to be monitored. So if your incentive is to do as little work as possible, then less monitoring probably means less work. Having said that, I don't know how many, like, I just really don't have a feel for how many people really actually have a job where they're super incentivized to do as little work as possible. You know, anecdotally from time to time, I've heard of people that are in that kind of role, but I've not really encountered them that much in real life. And just harking back to, you know, I guess like our Motley Fool days, I don't know about you, but like when we had that 1 day a week in the office, like I got so much less done when we were in the office. And I know it's by design because you're like there for like social reasons and you're having your day of week of like socialization or whatever.
Stave off the cabin fever.
I know that that's acceptable, but like I would always often like finish that day just being like, wow, I did not achieve the things that I like wanted to get done today.
Yeah.
So
no,
I
think that's fair. Yeah. I would say I worked at a call center, like to pay myself through uni and then for a big corporate. And both of those, there's a lot of people who are not super jazzed about it, right? Like, there's people who would like go to just like take a break and go to the toilet while they had a customer on hold. Like, it's not the same thing, you know, like it's just there's different levels, I guess, of people's like engagement that we're hopefully with like a lot of self-actualizers and like, you know, talking to a lot of other people who are like really engaged with what they do.
Yeah, look, I think there's a real possibility it can be part of it, but sorry for butting in there, Andrew, but I wanted to like just note one more thing regarding the productivity. I've noticed like with regards to the COVID pandemic, I've noticed there's like a real tendency for people to try to attribute, I guess, the symptoms of what we have collectively been through to a response to the disease rather than, you know, the actual disease itself, which I think it's strange because as if you're trying to take the more complex route. And I feel like it's possible that one of the reasons productivity is dropped is because you have considerable new disease burden in the population. And there's not really a great appreciation for that but it could totally be making people less productive. It's like at the moment, you know, you have people that are screaming about school attendance rates being down massively, as if that it was school closures or whatever that caused that. But actually, I think what causes it is that schools have COVID in them and people are keeping their kids home because they don't want to get COVID.
Yep. No, I completely agree. I think it's too hard to say what, you know, there's probably not even one cause either. All right, let's go through some small cap good news. Ding, ding, ding.
Well, it's something we kind of thought it's worth doing because it can be easy to sort of be doom and gloom. So I had a quick scan. I don't own shares in it. I don't know it well. But I saw on Strawman, someone mentioned Plenti. This is one of these sort of new fintech lenders kind of thing. They had their loan portfolio increased by 32% above the PCP and about 8% above the prior quarter, which seems pretty good. The automotive loan book reached the $1 billion milestone. They got a nice little chart in there of their loan portfolio, which is CAGR at 59% over the last 2 years. A nice little staircase there. So yeah, I maybe it is one to dig into more. I tend to be a bit gun shy when it comes to sort of lenders.
It just sums up what you're saying there, why I hate lenders.
Yeah.
Like for a growth investor, right? Because just think how easy it is. Like, I'm not saying this at all for Plenti, but like, yeah, they loaned a bunch of people more money. Like I could go loan a lot of people more money. I could 200% my loans to people. It's not going to have a good outcome for me.
It's
so
the
yeah,
new segment, questionable good news.
But no, I don't think that's anything. It's just it's not anything against Plenti. It's
this
just
stock's
saying
down like 95%. Like it's okay to have a few cracks at it, I reckon.
Oh yeah. But you know, celebrate. Hey, look, don't bring it down, guys. We're looking for some good news. I scanned for some good news. There's some good news.
Actually, yeah. I thought we only had one piece of good news to share, but I actually remembered another bit. So we got two. I've got two for small cap good news.
Go for it.
One of them is a company that we have featured before called Vysarn. And Vysarn was pleased to provide, a couple of days ago, Vysarn has announced a net profit before tax of 6.8 to 7 million for FY 2023. So I think that was up on the previous guidance, which I'll just get up for you, which was a little bit lower than that. So that's positive. And the share prices react. Yeah. So it was 6.6 to 6.5 before, and now 6.8 to 7. So a second upgrade there. That's pretty great result for them. The share price, I think when we started covering it, at least on a Rich Life, it was like 11.5 cents after the first upgrade. There you go. It's a good story for buying the first upgrade, because now it's 17 cents. So it's pretty much 50% up if you bought after the first upgrade. So this is why I love microcaps. Obviously didn't make a single cent out of it myself. Hooray for me.
No, it's great, man. And this was a water services company, right?
Yeah.
Yeah.
I just think that these are the kind of opportunities that exist in microcap investing. Like, just like it looks cheap after the upgrade, buy. Oh, damn, you get another upgrade bonus win. If you didn't get that other upgrade, you were still sitting on a little profit. But the problem is you have to be so nimble with these ones. It's not necessarily a long-term play that I can kind of get behind as a buy and hold. But basically, long story short, eventually I want to stop writing about stocks so I can like spend a lot more time punting on microcaps.
Nice. All right. What's the next piece of good news you had, Claude?
The next bit is one that I think is probably more prospective. Don't own it either, but AEF, they had their funds and management update out today, which I think, it shows a little bit of growth there, which is fine. Obviously, markets have been picking up a little bit, so the FUM is growing. That wasn't so much what I wanted to share as the small cap good news, though. Actually, I think the good news came about in June. And so I'm playing catch up from a month ago here. 15th of June, they basically came out. They did give a partial update on flows, which, showed an improvement, I guess. But also more importantly, they gave their underlying profit after tax with a much stronger second half. So I think that the underlying profit after tax is sort of a vaguely useful number. It excludes performance fees. And I think that there are probably some exclusions in there that I don't really agree with necessarily, but are still probably more one-off in nature. So that underlying profit after tax, at the low end of that guidance, it puts it on about 40 times earnings, which is not cheap for a fund manager. But I think, as I've discussed many times before, this is a bit of a special fund manager, as most of its funds are in superannuation in a cohort that basically is a younger cohort. So will be continuing to put money into their super for many years to come. That gives it some sort of embedded net flows growth over time. And I think we're at the point now where I'm not saying that the embedded growth justifies a PE of 40, but there are other positives besides that embedded growth that could definitely make the current price look all right, such as, the market goes up and it increases funds that way. Or, lo and behold, if it actually got another deal like with Christian Super where it absorbs another super fund, that'd be pretty massive as well. So there's a number of things that could be like ways to win. So it's an interesting one. And what I would say is that news that came out about a month ago, I would say that is actually... that's good news. And, the share price did spike on that day, and then it came down, and then it sort of come back up. So that's my other small cap good news for this week.
Awesome. Excellent. Well, let's wrap it there, gents. I covered a fair bit of ground today. Thanks, everyone, very much for listening. You can hit us up on Twitter. Threads is dead. We're not talking Threads anymore. I think
That was quick, wasn't it?
Yeah. Threads is over. So we'll stick with Twitter.
Called it.
at Baby Giants Pod. And hit us up on Twitter. Send us a message if you got any questions for us. Until next time, thanks very much for listening.
Thanks for listening, everyone.
Yeah, cheers.
Have a nice day.